Guys, let me tell you a 30-second story, and I promise you won't regret it. So, when I started to take investing seriously, I really didn't have anyone to discuss my ideas with. I knew no one in the investing space, and therefore, my process felt kind of lonely and very slow as well. So, I went on and found a community of serious microcap investors, people that actually like doing the work. And I'll let you in on a little secret. It's called microcapclub.com. Members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. The awesome thing is that you'll get exposed to ideas well before institutions ever notice them. And if you want to find great businesses and surround yourself with some of the best investors in the world, head to microcapclub.com and consider applying to join or becoming a subscriber. That's microcapclub.com. Nothing in this conversation is financial advice. I may hold positions in some of the companies we discussed or have other interests. I always aim to stay objective, but please take everything with a grain of salt and do your own research. What do I need to understand about your earliest days to kind of get to know you better today?
So just, I guess, go straight into it. Grew up in Nigeria, and I learned about the world of investing when I was 10. My parents had put some of their savings in the stock market, and they sometimes discussed about it at home. I was a bit curious on what they were discussing on, and I said, you know what, why don't I pick three companies that I was familiar with? I invested in those three. Two of them did well over, a period of time, while one of them fell by half of its value. And for me, I was like, I don't want to lose half of my money in any future investment. So I spent some time really trying to understand what had happened with that company. That company was First Bank Nigeria. And that was when I got to learn about the world of balance sheets, income statements, what makes a business, or why do revenue and earnings go up and down. And that was really my introduction to the world of investing.
Wow. Yeah, I think 10 years old is almost a record. I don't know when Buffett bought the first stock, but I think he was 7 or something. But yeah, you're close to it.
But no, just to disclaim, I didn't know what I was doing when I was 10. It was when I was 15. I think this was 2009. When I was 15, there was a crash. The financial crisis
Hmm.
made all the stocks go down. So, 2009, I was buying at the low point. I didn't realize, but by 2014, they had gone up in value. And that was the period when I actually started trying to understand, what really was behind the stock symbol called First Bank Nigeria or Nestle Nigeria. And yes, I wouldn't say at 10 I knew what I was doing.
Got
Yeah.
it. And help us understand how you made like the transition from living in Nigeria, I guess, because I did some background work on you, and obviously you're based in the UK right now, and you studied in London. So yeah, and just curious to know like what happened there. Maybe if you can share that, and what lessons can you teach us from that experience transitioning from, I guess, an African country to the UK.
Yeah. I think there weren't too many barriers because one, the main language is English. So moving from
Yeah.
the UK, Nigeria to the UK, there wasn't that language barrier. A lot of people have it much tougher where you're either speaking a second language or having to even learn a new one. So I didn't face that challenge. And luckily, the secondary school I went to in Nigeria, they had an affiliation with the school. I started my sixth form in the UK. So I had
Mm.
some friends with me, I could still, and have the same Nigerian banter with them. And I think I just gelled with the people here. I did my A-levels in North Yorkshire in a school there, and I did my university in London School of Economics. But I think the passion for investing never really died. While I was in university in the UK, I started an investment club, and the goal for the investment club was basically raising 1,000, 2,000 pounds from friends who were also in university. And I just basically invested that in the stock market, mainly the South African stock market. Um, I think the big learning point for me, I think if I was speaking to my younger self or
Yeah.
people who are that age now, is I think whatever your passion is, when you're in that stage of life, you want to find the simple ways that you can further build on those passions, whether it's investing, whether it's sports or, something more creative. I think we just want to hone in on those passions, because you never know where it leads to.
Got it. Got it. Yeah, it makes perfect sense. And just help us grasp how big is the investing culture in, say, Nigeria or South Africa, because I don't know many investors from those countries. I guess there are a couple from South Africa, but yeah, let us understand if you were like a child prodigy and just kind of interested in investing because you're super smart, or is it something normal there?
I mean, I can't really speak for South Africa, but South Africa, I mean, from my experience I didn't grow up in South Africa, but from my experience
Yeah.
investing in South Africa, the investment scope it's well, quite developed. There's an investor there, Alan Gray, who's
Hmm.
basically the Warren Buffett of Africa in a way. Peter Lynch actually did an interview, I think it was published earlier this month, and in the interview they asked him who was his mentor. And he said his mentor was Alan Gray, who also worked in Fidelity when Peter Lynch was there. And, he built three successful investment companies, one in South Africa, one in Australia, and Orbis, which is more of a global strategy. And there are a lot of people who have come from Alan Gray and built their own firms. And I think that's the one side. The second side is if you look at the actual companies, there's been a lot of great businesses that have actually come out of South Africa in the public markets. So there's actually opportunity there. With Nigeria, it hasn't had the same success as South Africa from a public markets perspective. Very few, I guess, legendary investors brought in Nigeria terms, but none to the scale of Alan Gray. And public markets is much less developed. There are less number of companies, low quality of companies as well. So
Hmm.
I don't know the percentage, but if I could guess, I would say a larger percentage of the assets under management in Nigeria is in retail. Individuals, families who just want to, make more with their savings. And I remember the stat was like probably like Nigeria's a population of 200 plus million people. Probably 300 or 500,000 people actually know how a stock market functions. So the penetration from an education standpoint and also from an AUM standpoint is very low in Nigeria.
Okay, makes sense. Yeah, it's just interesting because I really never delved into that space. I guess most investors I know are based in Germany or the US or like across Europe, I guess. So it's very interesting. So another curious fact, or I guess interesting thing you did was uh, launch a fund straight out of university, right? So can you guide us through how you did that? Because I think that's super rare, first of all, and yeah, secondly, I don't know that many people have the ambition of, okay, let's launch a fund straight out of university. And so, what lessons have you learned there, and can you guide us through how you've done that?
Yeah. So I mean, the first thing when I started university and even when I finished university, it wasn't my intention to actually launch a fund out of
Hmm.
investing. What had happened was, like I mentioned before, I'd set up an investment club
Yes.
with friends. Initially started off with just six friends who gave me 1,000, 2,000 pounds. And then over time, people saw the performance, more people became more interested in the investment club, and then it grew to about $250,000 dollars. Then
Wow.
when I was leaving, a family office, had reached out and they wanted to learn a bit more about what the investment club was doing because I was also writing research on South African equities. I remember writing about like, the retail sector and the security fleet telematics industry, and they were interested in that research. And also I was investing globally as well, and they were basically interested in the research. And they said, if you're really into this and you actually want to scale this, would help you out, give you some AUM to manage. And if you do well, we'll extend that. And for me, I think that was the real turning point where I realized, investing is a passion. It's something that I really enjoy doing. There are different paths to actually building the passion, but Every day I'll wake up, go to the Bloomberg terminal in the LSE library and read about different companies. And I just wanted to spend the rest of my life doing that. And so the goal was really to build on that passion. And I think the process of building on that passion led me into starting a company. And I think the second part, I was very lucky. So our current COO, Anil Joshi, I met him in 2021 through an introduction from Prime Brokers. And without him, I wouldn't have been able to launch because I think the less talked about bit with launching a fund is, the compliance, the regulatory bit, the legal. I had no interest in all of that. But Anil, he focuses on helping young startup managers building that. So I met him and he
Mhm.
just gave me lots of pointers, lots of tips on what to actually do. And he was a real, guide in that aspect of launching a fund. Together, we made that possible. And then we got licensed by the FCA. I was actually quite surprised by that. But we got licensed by the FCA at the end of 2022, and then we launched our offshore vehicle in the following year. And since then, it's not been a straight journey upward. It's had its ups and downs. But I mean, from an advice standpoint, launching a fund requires a lot of capital. It's not a physical asset business. I mean, the good thing about physical asset businesses is that if things go wrong, you can sell the asset to someone else, so you can recover some of the losses. Whereas with a fund, it's intangible, it's relationships, the payment you pay for service providers. You can't recover that. So the risk in, I guess, failure is actually higher there because the sunk costs
Yes.
are much more. So again, you just want to really have a budget and stick with that budget when you're in that process of fundraising and the process of launching a fund. I think the second bit is that it's the fundraising bit. For me, I had underestimated how much effort, time is really required to build in the fundraising side. Because again, you want to focus on the stock picking, but you need a certain AUM to break even and be able to cover your cost and grow your portfolio and all that stuff. I'd underestimated it. It requires a lot of work, just building that out. So you really want to have a good understanding of what your fundraising strategy is and having KPIs, to make sure that, you're hitting your target, whether it's just AUM or whether it's relationships and all that stuff. So I think
Mhm.
those are the key, the key lessons I would say from building a fund.
Yeah, there are so many places I'd like to go or take this conversation. But the first one I'm curious about is how did you structure the fund? Because uh, from the several conversations I've had with fund managers, I guess that the structure itself or like the incentives you set for yourself and investors is one of the most important things. So, how have you thought about it and designed the structure?
Yeah, I mean, I try to just keep it simple and similar to the industry. And if you look at the industry, most funds charge a management fee and a performance fee, and the performance fee is usually determined by either a benchmark or a hurdle rate. So I pretty much just structured the fund like that. And my thinking was that, um, if I look at myself internally, like I'm different from most fund managers, either in terms of age, culture, nationality. So I didn't want too many things to be different from what, you know, investors are actually looking for. So I just tried to make sure that, the incentive, the fee structure, the fund structure. So we used Cayman Island for the fund. We kept an option for managed accounts because some investors, actually, from my experience, most investors prefer using managed accounts with new
Mm,
managers. So we kept that option available. I just try to keep the structure as simple and as familiar as possible. We didn't do, I wasn't creative with that. But again, managers are different. I know some managers who found it quite successful using the Buffett partnership structure where there's no management fee, but then there's a performance fee, which is usually at a higher rate. And then there's some other managers like Terry Smith in the UK who runs the Fund Smith, who doesn't actually charge a performance fee but only charges a management fee. And if you look at fee expense is actually lower than what, Buffett was charging when you do it on a like by like basis. So, I mean, there are different structures. For me, I just wanted to keep things simple and industry like.
Mhm. Got it. Perfect. And the other thing that was really interesting that you mentioned is that when you were running the investing club, you were doing some industry research on retailers and stuff. So I guess that's not too different from what you're doing today. You're posting these really interesting deep dives on certain industries and geographies and all of that. So I'm I'm just curious, does that is that like the normal process for you? Do you kind of go like into an industry and try to screen for all the companies in the world that are in that industry and pick the best ones, or how does it work for you? Yeah, maybe that could be a good way to go.
Yeah. So, I mean, it's that process has evolved. So when I started, I was only looking at South Africa. South Africa had between 150, 200 companies. So it was very easy to go from A to Z. Like, I mean, if you spend 5 hours on each company in a matter of months, you can go through each of them quite quickly. However, now we have a global equities mandate and
Yeah.
global equities mandate above companies with $50 million market cap. And if you look at that, it's like 29,000 plus companies. So trying to use that same process of, looking at each company, spending some time, it's quite impossible. So you kind of need to have different ways to filter out certain businesses. In the past, I used to use a lot of stock screeners. So maybe screen sectors by their operating profit margin or by their return on capital and that sort of thing. Initially, it had some good results, but I saw quite a number of flaws, with that process. Especially, it actually took me about 2, 3 years to realize the flaws with that process. So in the past year, our process has kind of changed a bit. So what I do is that I first break down the world into 60 different industries globally. And then within that 60, there's 15 of them, 1 5 that we can invest in. And then
Yes.
within those 15, each year I try to spend time assessing 6 of them. So for example, this year we've looked at transport infrastructure, where you'd have companies like airports, ports, always type businesses there. Another sector we've looked at this year is grocery retail. Well, it's the broader one is consumer staples, retail. There you have grocery retail, you have drug retail, and you have distributors. So we look at it from an A to Z standpoint. That process is broken down into 4 steps. The first step is just spending 5, 10 minutes with each of those companies and really trying to understand what's going on really, really quickly. So just trying to understand, are they profitable? Um, do they have good unit economics? What do they actually do? Where in the value chain are they? And usually I spend about 5 to 10 minutes on each company. And then if there's a list of 500 companies in that industry, I'll try and take that list to about 50 really quickly. The second step, which I try to spend about 40 minutes to 1 hour on each company, is taking that 50 company shortlist to maybe 10 or 15 companies. And then the third step, which is where the real work starts, I'm spending, 6, 7, 8 hours on each company, and then I take that list to about 3, 4 companies. And then that's where the real deep dive really starts, where, going through all the annual reports, going through quarterly filings, going through, just broader research. That's the more fun bit. And
Mm.
then in that process, we might invest in 1 or 2 companies or decide not to invest in any of them. But that's how the process at Jenga works at the moment.
It's really funny that you said that the real work starts after you've spent, I don't know, how many hours in I mean, because I was just thinking like some of my friends might be listening to this, and they might actually say, okay, my real work is like the 5 to 10 minutes screen uh, in the start, and then yeah, I guess not many people actually do the work. But anyway, I was just also curious about one point, because basically you said that there are 15 industries you can look at or invest in, and you try to look at six of them each year, or like in a given year. Um, I'm just curious if that's kind of a results into a biased portfolio, in the sense that, let's say you're kind of investing or like investigating the retail sector, then by the nature of your work, I guess your portfolio will be more weighted towards the retail sector side. And then if you do like transportation, then you'll add some transportation names. So how, because for example, for me, I'm not focused that much on industry. I just like get ideas from everywhere, and yeah, independent of the industry. So maybe help me unpack that, and yeah, just let me know where I'm wrong.
No, I mean, I think you've raised a very good point. I think that's a very good question. I mean, the thing about bias is everyone is going to be biased. The more important question is what's driving that bias? Like, why exactly
Hmm.
are you biased towards grocery retailers? Or if it's geography, why are you biased towards US? So, for example, if I'm South African and my portfolio is 100% South African, my bias is in South Africa. But the reason behind that is that that's where I'm from. That's a market I understand the best. And I think that's a fairly good bias. Now,
Yes.
where our bias is in 15 industries. And now the reason why we have the bias there, there's six attributes. So the first one, circle of competence. That's where I think I have a better understanding of, the business drivers of how they make revenue, how, their cost structure. That's where I have a better understanding. So that's the first one. The second one is that the industries that we've selected are the ones where we feel there's a lower degree of cyclicality. So what I mean by that is if you look through the cycle, so for example, grocery retail, whether there's a pandemic, there's economic crisis. If you look at the grocery retailers, if you go back to financial crisis and the internet bubble, and even the depression, there was still demand for their services each day. So that's a factor that we like at Jenga, and when we're trying to understand industries. Um, the third factor is the capacity for innovation. So again, some industries have more capacity for innovation. And the good thing about innovation is that it leads to revenue and earnings growth. Um,
Hmm.
so again, software is one example. That has a high capacity for innovation when you think about Microsoft, for example, and all the innovative products they've built over the years. The fourth factor is the barriers to entry. So again, I prefer industries where there's a structural higher barrier to becoming a player in the market. So again, if you look at retail, I don't like every retailer, but the reason why I like grocery retail is that when you look at, I keep going back to grocery retail, but when you look at the cost involved, the amount of the size of the distribution, the real estate investment, the people you need, it's much, much harder to start a new grocery retailer than maybe starting an apparel company. I had friends, when we were in university, they could start, an apparel brand where they're selling shirts very easily and, that they could get some level of success. But trying to sell fruits, vegetables, rice, that's much harder because it's a skill game. And then finally, we're looking for industries that have a track record of outperformance. So
Mm.
I did this research over the last 30, 40 years, last 10, 20, 30, and 40 years, and tried to pick which industries showed a more consistent track record of outperformance. And some industries do better than others. So for example, the tobacco and beverage sector has done very well. If you look through the last 40 years, again, some people might say, yes, that was the past 40 years. The next 40 years might look differently. That's obviously true. But again, I just prefer to tilt towards industry where there is actually a track record, of outperformance there. So again, that's how I formed my bias towards those 15 industries. Now, just a small caveat. That doesn't mean I'm not going to invest in a company that's in the remaining 45 industries. The 15 is just where we focus. So maybe 90% of the portfolio will come from there. And then a small percentage, 5, 10% of the portfolio might just come from opportunistic investments, either like you, I was looking through a certain of another investor and I saw a company there and it looks quite attractive. And I do some more digging and I realized it's actually a very interesting company that has what we normally like in businesses, but it's just from a industry that I don't really like. I'll still invest in that. And that's happened in the past. So, I mean,
Mm.
that's the process.
Perfect. Yeah, I think that's very practical. And I always like to keep the conversations practical because when you get too metaphysical, then it's hard to derive lessons to your own process. But so my next question to that point is, what have you learned specifically about retailers that maybe can help other people understand retailers better? Because I'm not like the biggest expert on retailers, to be honest. So maybe it's a more of a selfish
Yeah.
question.
Yeah. So, I mean, the number one thing about retail is that it's one of the most transparent industries out there in the sense that you and I can walk into a store. We
Yes.
can see the products that are in the store. We can see the people who are in the store. We can read, Reddit and all these blogs online to see, which stores are doing better than others, both in discretionary retail and then in staples retail. So it's quite transparent. The second thing is that there are categories of retail. So I just basically put them into two buckets. There's discretionary retail and staples retail. Discretionary retail is basically home improvements, leisure retail, apparel retail, but basically retail products where the demand is a bit more lumpy. So it goes through either the economic cycle impacts the demand. So for example, when you think about home improvements retail like Home Depot, when people are spending more on either refurbishing their homes or moving into homes, companies like Home Depot are going to probably do much better in those periods. If you look at, I guess, apparel, when I guess there's a bit more of an economic boom, people are more likely to spend a bit more on the clothes they wear, the jewelry they buy. So that type of retail tends to do better. Now, from that standpoint, you want a bit, I guess, focus a bit more. Obviously, like, the companies would differ. So if you look at luxury, for example, Hermes, LVMH does much better than some of their peers. So there will definitely be
Hmm.
idiosyncratic, factors in play. But you want to be quite careful about the cycle because you could buy a good company, but you're buying it at the wrong time and that leads to detrimental impact. And I've lost money from making that mistake. So it's a mistake that, I guess everyone learns from. Then the other side of the retail, which is the one I'm more interested in, is the staples retail, where it still has exposure to market cycles, but there's a lot more resilient because what they're selling are everyday items. So you think about grocery retail, you think about, the amount of times, you buy food products, packaged food, tin, cans, all those sort of things. It's a bit more stable through the economic cycle.
Yes.
So I'm less worried about I guess, the external factors. And I guess 90% of the research there is more about how the business works. So that's basically the stores, the real estate, the product catalog, so the SKU, the revenue model. The revenue model is quite important. So for example, in the US, Costco, Walmart to a smaller extent, and BJ's Wholesale Clubhouse, their model is that a significant portion of their revenue and a larger portion of their operating profits comes from membership cards, usually which has about 90% renewal rates. And I think they cost between 60 to $100 per annual. But the beauty of that is that the revenue model is a lot more stickier, which
Mhm.
gives the retailer a longer time to actually plan their SKUs and their product catalog. It gives them a more recurring earning, so they can actually plan store growth with with a longer term horizon. That's also, there are normal retailers where there isn't that you know, membership revenue and profit coming in. So there is still a lot of difference, and also geography. They're quite different as well. A retailer in Indonesia will be different from a retailer in Brazil just because of the geography,
Mhm.
because of the economic GDP per capita and all some other factors. So there are lots of intricacies involved there, but I generally prefer the staples retailers over the longer term.
Got it. Perfect. Yeah, that's very interesting. I think the only retailer or the only two I really studied were Costco and Dino Polska, and so yeah, I think that's still an area I'm very ignorant, and maybe I can learn more from your research in the future. Another industry you studied is transportation, and I'm more specifically interested in airports. So maybe if you could share as well, like break it down for us, and then maybe also I have a follow up, but I'll let you, yeah, drill down on that first.
So just taking a step back, whenever I look at a company or industry, 50% of the research is about quality,
Yes.
25% is on the earnings growth, and 25% is on the valuation. Now, that's how I am now. But in 3 years ago, 5 years ago, I used to focus a bit more on the earnings growth and the value. And I made a lot of mistakes when I look back at some of the investments I made in the past. And I think my learnings from that investment is focusing a bit more on the quality side of the business. Now,
Mhm.
the issue with quality is that it means different things to people. Some people, quality is simply return on capital or the operating profit margin. For some other people, quality is pretty much just pricing power. I try to take a bit more holistic view of quality, and I kind of have categorized it into 10 different buckets. I wouldn't list all 10, but some of the factors in there are the barriers to entry, the pricing power, the culture, the test of time, the nature of demand, like I was talking about, earlier during the podcast, and some other factors. So after I bucket those 10 different categories of quality, I'm trying to look for companies that do well across those 10 and they do very well in each of them. Now, airports, well, transport infrastructure overall, so ports, airports, railways, they do quite well. And just, I guess, digging a bit more deeper into airports. First of all, airports are necessities. Pretty much every country has an international airport. You can't fly in and out of a country without an airport. So it's a necessity, and it's going to be there. Now, the second thing is that it's very hard to build an airport, even if you have the regulatory approval, um, and all the pass from the government. It takes a very, very long time. It requires an amount of capex. Most times, it's actually the government who are the ones building it. So there's a high barrier to competing with an airport. So it passes my barriers to entry test. The third thing, which differs airport to airport, is that if you look through the economic cycle, the airport demand especially is quite stable. Not 100% stable, but it's more stable than not. And again, there are a few things that would impact airports. So for example, majority of your passengers are coming from tourism. There's an economic crash, tourism drops, so you're probably going to see less demand during those periods. And also with business travel, if there's lower business activity, there'll definitely be some cycles there. But if you look through the cycle, and I think the great thing about airports is that they capture a significant portion of the profits of travel. So airlines usually would have an EBIT margin of around 5, 6% in a good case scenario. Airports, usually they have an EBIT margin of about 45 to 55% EBIT margin. So it's generally more profitable. They capture a largest segment of the passenger flow. Now, that's the regulated segment of airports. Now, I think what's really interesting about airports right now, especially in emerging markets, is the non-regulated revenue. So that's basically the revenue they make from beyond just passenger fee charges that they'll charge to each passenger through the airlines. That involves things like car parks, car rentals, VIP lounges, duty free, retail, all sorts. Again, each airports are different. So I'm invested in a couple of the Mexican airports. One of them, which owns the airport in Cancun, they are more focused on duty free, retail and car rental segment of that non-aeronautical revenue. And they've done quite well there. And then some other airports, the other one I own is the one in Monterrey. And that one is more focused on VIP lounges because the flow of passengers is a bit more business. And also
Mhm.
because it's located in the north part of Mexico, just right beside the US. there's an
Yes.
opportunity to also grow the logistics revenue of airports. So that's bonded warehouses and helping companies like FedEx and DHL transport, products from Mexico to the US and vice versa. So they're more exposed there. And I think there's an opportunity for a lot of EM airports to grow that by almost 10%. So a mix of pricing power, being able to raise prices by 4 or 5% each year, and then a volume growth of an additional 4 or 5% each year. So overall, there's an opportunity for growth. There's an opportunity for high quality earnings. There's high barriers to entry. It's fairly stable through the economic cycle, very profitable. And I think the final, important factor was the valuation. So if you look at the valuation earlier in the year, a lot of these airports were trading at 12 to 15 times earnings. The market is around 22, 20, 23 times. And bear in mind, these airports make more revenue, more profits margin than the average company. I think they have a higher barriers to entry. They have a higher quality profile than the average business. So I thought there was a bit of dislocation there between the price we're paying and their actual earnings value. But again, each airport is different. They have their own risk. The one thing I didn't talk about is the concession. So again, if you look at a lot
Hmm.
there, I think there are about 24 listed airports. In
Yes.
emerging markets, majority of those airports, including Thailand and I think China, the airports are on concessions. So the listed company has a concession from the government to operate that airport over a period of time. It could be 10, 20, 30, 40 years. Whereas in the developed markets, mainly Europe, the listed airport actually owns the airport outright. So there's no concession risk that the government would take their concession away. And as a result, you will notice that the earnings multiple, again, that's very justified, is more higher in European um, airports than, in Latin America or in some countries in Southeast Asia.
Perfect. Makes total sense. And have you ever looked at Fairfax, India? Because I guess the case there is also about obviously they have the other side of the business, which are it's like a holding company. But yeah, just curious.
Now, I mean, I've looked at it, but not to a deep extent, as much as I've
Hmm.
looked at the other ones. But I know a lot of clever people who are really interested in Fairfax, India. And actually, I published a deep dive on airports earlier this year. And if you look at the comment section, most of the comments have been about looking at Fairfax, India. So it's still on my list of other airports to look into. But I haven't looked at it to a great detail.
Perfect. Okay, just curious. I guess it was also a big topic of discussion during the European Value Investing Conference. Yeah, I think Jeff Stacy is big on Fairfax India. Yeah, just curious. And in terms of companies you're looking at recently, or just maybe a case study you can give us that kind of encapsulates your whole process, maybe that would be the perfect way to end this more practical side of the conversation.
Yeah, I mean, I could talk a bit more about I could talk a bit more about transport infrastructure, but rather than talking about airports, you know, I, I'm happy to share about Philippines port operator, and it's called International Container Terminals,
Okay.
and it's listed in Philippines. It's about a $15 billion company. Now, with I think the difference between airports and ports is that ports have less room for growth because
Hmm.
again, if you think about the core items that go through ports, these are like everyday, ports, no, sorry, these are everyday containers that transport either industrial products or materials or mining and all sorts. And that has much less room for growth compared to like tourism. And I think the second side is that the port business model is probably 100% regulated revenue. So with airports, you have maybe 65% that comes from the regulated um, airport passenger fees, and then 35% comes from duty free and the non-aeronautical revenue. With ports, it's pretty much 100% regulated. So the opportunity for growth on each port is, I guess, much less than airports, but at the same time, it's still quite profitable. So what companies then do is that there's a lot more acquisition drive in the ports industry than in the
Mm,
airport. So again, if you look at the listed airports, a lot of them, most of them have majority of their revenue coming from their home country. Whereas in the ports industry, you have quite a few very global players in the ports industry. So, I mean, you have very big guys like CK in Hong Kong. They own ports everywhere around the world. In international container terminals, they're more focused on they're more focused on emerging market ports, usually tier 3 ports. What I mean by tier 2 and 3 is that the volume of tons that go through these ports are much less. So we're talking about 1 million to 2 million, 3 million T um, containers each year. International Container Terminals was founded, I think, in the late 80s um, by its current CEO, Enrique Razon. But the history of, their management, the main port is in Manila in Philippines, but the history of that goes back to, I think, the 1940s. So his grandfather was actually the original person who won the contract to operate, different berths in the Philippines port, and then it was passed down to his father. And I think the story is that, when Henry Crasson was in university, he dropped out of school and he really wanted to work in ports. So he left university and went to work into the family business. And I think in the 1980s, the Philippines government decided to privatize the port fully, and they won that privatization for a significant amount of time. I think it's been renewed every 25 years. They've been, they've done quite well in the Philippines. They've grown the ports there very well, at double digits, low teens. If you look at the revenues and profit each year over the past, 2, 3 decades. The more interesting bit is what they've done outside Philippines. In the 90s, they realized that, if because they had successfully managed the Philippines ports, which was one of the first ports to go public, back in the days, and they realized that as more countries look to privatize their ports, they had a case study of successfully managing emerging market ports. So they went on a huge acquisition spree and aggressively acquired ports, in emerging markets. So Mexico, Brazil,
mm-hmm.
Indonesia, and all these, Saudi Arabia, and all these fast growing emerging market. However, in 2000, actually in the late 1990s and early 2000, there was an Asian financial crisis. And even though the profits in the ports were still quite good, national container terminals had borrowed aggressively during that period, and they had to make a decision. We're either going to have to, you know, the banks literally will be at their necks for the next 10, 15 years with debt payments, or we sell some assets. So they decided to sell some assets to CK Hutchinson's during that period. And it kind of built the international container that we know today, which is a more conservative port operator. They're still aggressive, but a lot more conservative than they were then now. So today they manage 33 ports in about 19 countries. Outside of Philippines, about half of the business, but outside of Philippines, Brazil, Mexico, Honduras, Poland, China to a small extent, Indonesia to a small extent, and I think they are currently winning a bid for South Africa as well. But basically, the thing is that they're still growing quite well in emerging markets. From a shareholder standpoint, they've done very well. From a performance standpoint, they've CAGRed around 18% annually since they went public in 1992. They still continue to do quite well. They earn EBIT margins of plus 50% each year. They grow in multiple ways, volume growth, pricing growth, because every 5 years, usually ports would apply to raise the tariffs with the government. They're doing very well on that, especially in Latin America, Brazil and Mexico. And overall, I mean, when we invested in the business earlier this year, it was at around 15 times earnings. And this was a business that I was certain that they could have 50% plus EBIT margins while also growing the revenues and bottom line by about 10% each year and paying 3% dividend yield. And I thought that was an attractive price. So far, the results have been good. But again, this is a long-term investment for myself. And
Hmm.
I think it's a good case study of what I'm looking for. High quality businesses that have high barriers to entry, low degree of cyclicality, they've tested time, they have a good culture, owner-oriented management team. And also quite important is that they're underpriced with potential for growth. So I mean that's the international container terminals.
Perfect. Yeah, I think that's a very interesting story. Never heard about ports, and especially ports in the Philippines. So, yeah, definitely very, very interesting. Um, and one thing I'm always kind of trying to balance is between studying companies that I really like and companies that might be more boring but offer a better opportunity exactly because they are boring. So how do you balance that? And yeah, maybe you can just give us your experience on whether being biased towards studying like more exciting or interesting companies is correlated or not with better or worse returns.
So what gets me excited about companies is the risk reward. So for me, I
Okay.
mean, what keeps me excited? I mean, ports might sound boring, but the risk reward in ports is quite attractive. I
Got
mean,
it.
I remember when I was reading through the 1990s and early 2000s annual reports of international container terminals. And for me, I mean, I felt like I was reading a really cool novel because I felt the risk reward was quite interesting. Investing is not supposed to be exciting,
Hmm.
in the sense that you're not meant to be reading annual reports, and it's not meant to, like, you're not meant to be focused on just companies that get you excited
Right.
in a plain sense. You want to really be focused on the objective. The objective is that you want to grow your investments and your savings. If anything, that's what should be exciting you. So I kind of start with that ground zero as my starting point. What exactly is keeping me excited is the fact that I get to grow my savings and savings of my clients. And from that, I then focus on companies that will allow me to achieve that. For me, I prefer holding companies for a long time. And I prefer doing deeper research. Mainly because that's where I believe my skill sets lie towards. Some people do it with, short-term trading, and it works for them, but you have to find which one works for you. And, the longer term value investing, Buffett-like investing works more for me. What keeps me excited are the opportunities that where I feel I can compound a bit more than the average opportunity. And that's what I focus on. And I think that's what most people should focus on.
Hmm. Yeah, I think that's great. And what sort of, I guess, the last company you talk about, port one in the Philippines, is it the one that you enjoyed studying the most recently, or is there any other one that you prefer?
Yeah, I mean, so I think there might be, I don't, we haven't yet finished the due diligence. I could talk about it. It's Grupo Mateus in Brazil. It's a grocery retailer in northeast Brazil. Um, and what I've learned is that northeast is it has the lower income per capita of Brazil. But anyways, the case there is that they have 270 stores. We target to grow about 30, 40 stores, no, 20 to 30 stores each year. They have a very impressive track record, of growing about 20% in revenue and profits organically. And right now, the shares are at 10 times earnings. So that's really interesting for me when I see, a company that has good quality characteristics, is growing revenues and profits. But then you look at the valuation, it doesn't really add up, especially when you even compare it to like Dino Polska. We also own Dino Polska in Poland. Has a
Hmm.
similar unit economics and revenue model. It has a similar unit economics and growth profile. but then Dino Polska is at 23, 24 times forward earnings, whereas these guys are at 10, 9 times earnings. So
Mm.
that's been quite interesting, but we haven't yet finished the research into them. And I think a couple of weeks will be done and we'll see if there's anything fraudulent going on or if it's actually a good opportunity that deserves some capital into.
I was about to ask you on that because I'm curious to know what's the role of primary research and how do you find out like whether these guys are honest or not? Because yeah, obviously you're not in Brazil. I'm not sure how often you travel to Brazil, but yeah, just curious about that and maybe
No, I've
what
never been
lessons
to
you have learned.
Brazil, and I don't think I'm going to visit Grupo Mateus even if we invest. But I mean, it's a lot. So I think you could. It's about learning the facts, and there are different ways to learn the facts. Obviously, if you're in the country, if you're in the environment, you have a much more higher you have a much higher opportunity to actually learn the facts. You can visit the stores. But I think social media, the internet has actually leveled the playing field to some extent. So yesterday I was actually doing some online groundwork on Grupo Mateus, and there are hundreds of videos of people shopping in their stores in different parts of Northeast Brazil, and you can see the reviews on Google Maps. I think you look at a lot of their stores, they have like 4.3. If you look at Carrefour, which is the largest player in Brazil, they have about 4.1. You can see the similarities, the differences. You can see how close they are. You can see, how easy it is to get to from the urban region. There's just so many data points. There are interviews of the
Mm,
founders. You can read about the founders' history. You can see past annual reports. You can see past quarterly filings. Also, the Brazilian Supermarket Association, every year they publish um, a top 100 list of all the supermarkets. You can see their number of stores, you can see the efficiency per store, you can see which one's growing the fastest. So there's a lot of data points that one can look, even for the private companies in the industry. Um, so, I mean, I I mean, it's just a lot of data to even pour into, and I try to focus on where I can. Now, that said, there are some companies that when I look at them from a top-down view, from an industry level, they look quite interesting, but I just don't feel confident with the data points or the range of data points I actually have access to. And what happens in that case is that I just pause the research there and move on to something that I feel like I have a bit more conviction on. And another lesson I've learned is that even though I'm from a certain country or I'm based in a certain region, that does not necessarily mean that a company in that country is going to be within my circle of competence. So, for example, I don't do much Nigerian investing, but I've never been comfortable with the balance sheet of Nigerian banks. Even if I'm in Nigeria, even if I have a bank account with them and
mm,
I know the whole person, I know 100 people in the employee workforce and all that stuff. I don't think I would ever be comfortable with really what's going on in the balance sheet. So again, because I'm in Nigeria and I'm based in Nigeria, I live in Nigeria, and I use the account doesn't necessarily mean that I'm actually going to be an expert. And the other one is that I know some other people who were not from Nigeria, but then they looked into certain Nigerian companies, but they looked at it with an international lens and they're able to see, I guess, the future growth much better than I could. And they actually
yeah.
did well investing in those companies, and better than local Nigerians. And the same thing goes for, all the parts of the world. So again, I think it's just finding your edge, um, and just sticking with that. For me, again, I focus on a few number of industries. And if you look at a lot of the industries like I spoke about today, so for example, grocery retail, airports, a lot of them, they have a unified accounting and regulatory body. So airports, for example, they all have to, they have a global regulator. The global regulator publishes annually what, which airports are the good ones, which are the bad ones, which are doing well passenger growth. So you can actually see what's going on. Each airport also has to publish their monthly passengers. So every month you can see which airport is growing in terms of number of passengers. Passengers is the main KPI for airport revenue. So they're quite transparent from that
Hmm.
standpoint. So that gives me a lot more confidence and comfort when I'm investing, in an airport, regardless of how where random the location is. Same with ports.
Yeah, that's definitely an interesting insight because there have been some people curious about Portuguese companies. And when they come to me, I say like, "Wow, oh, how are you looking at this company? Like, they're like a post office provider, but then maybe I don't even know they have a bank, or I don't know they're also like logistics partner for Amazon or whatever." So yeah, sometimes people outside know more than the people inside, or have a more
Yeah,
balanced view, right?
yeah.
So that's pretty interesting. And which investment has surprised you the most in the past and why?
Oh, that's a good question. The one that surprised me the most in the past was a company called Shelly Group. They're
Ah,
based in
I know.
Bulgaria, and they basically make a lot of smart home solutions. So if you're in your house, you want your blinds to go down at 7 p.m. every night, you install Shelly products to your electric circuit, and you have the app on the phone, and you can do all these cool things. Now, when we invested in Shelly, I'd never been to Bulgaria. I wasn't, I'd done some readings, of course, on the smart home solution market, but I wouldn't say I had some unique insight over an industry analyst in the smart home market. But what I did have a sense of was that, I mean, from my research then, was that the management team at Shelley, the two co-founders in the team, were very unique in terms of how they manage their balance sheet, how they focus on innovation, how they cared about, their customers and the customer feedback. I remember going on like a Facebook Shelly Group marketplace where you could read comments and you see the founder, Dimitrov, responding to comments from customers in Brazil or wherever they are in the world. And for me, I just saw a very deep level of commitment from the management team, and we invested in Shelly. It's done quite well for us as an investment. I've gone to visit Bulgaria. I've gone to visit Shelly 4 times now, no, 3 times now, in Sofia. And every time I go, like, I look at this, I look at the multiple, I'm like, yeah, this is a bit higher than what we really want to pay for. And then I go to Sofia and I really get to see I mean, they've moved into a bigger office, but when I went to the initial office, it was really cramped up. I couldn't get access to the founder because he was in a meeting on product development. And then I saw him walking out and I quickly said hi. Anyways, I got this sense of a very good culture. And I think it just
Hmm.
surprised me. It reminded me of the importance of, the culture side of the business, the people side of the business, beyond just the balance sheet. Of course, the balance sheet is still quite important. The quantitative side, the numbers are still quite important. But it just kept reminding me of how much value can be created when you have good people who are really focused. And that surprised me to the upside. We still own Shelley. And I hope to visit them again, maybe early next year, just to revisit the thesis. But it's really surprised me. It's not necessarily a high quality industry, and I wouldn't even say it's a high quality, high moat business. But the culture has really helped them, grow grow the revenues and profits in a good way.
It's fascinating how some countries you'd never imagine have so yeah, such interesting companies. I actually was aware of Shelly, and it's very interesting. And then you have some other ones in Lithuania like Revolut and stuff. They are private, but it's it's kind of interesting. You never associate them with even capitalism or startups and
Yeah.
stuff. But yeah.
Yeah, one thing I would say when I went to Bulgaria, I mean, I do this thing when I go to a country, I try to meet other companies because one, I don't want to travel to a country just to
Yeah,
visit one company. Then I feel like I've wasted, my
yeah.
budget. So I try to visit as many companies as possible. So when I went to Bulgaria the second time, I was like, I'm not going to go just to visit Shelly. I'm going to try and visit 6, 7 other companies listed in Bulgaria, and there's a few of them. I think there's about 30. There's about 30 plus with $50 million market cap is in Bulgaria. So we went to visit a few of them. And I was so impressed by, the growth, both internationally and domestic growth of Bulgarian companies. I remember there was one called Speedy in the logistics field, and I just got to see how they really handle logistics. I mean, it sounds like a very broad industry, but this is a company that has grown revenues and profits by 15% each year for the last, I don't know, 15 years plus. And there were lots of different businesses like that. You'll be really surprised by, the level of opportunity in these lesser known countries, both in frontier, emerging, also in the developed market space. So I think there's a role for global investors who are willing to, go to these, countries and really dig under the hood for, that one, two, three companies that are actually attractive from an investment standpoint.
Yeah, for sure. And I guess it's also a fun way to approach investing because you get to know cultures and all of that. Perfect. I think just to wrap up, I really wanted to ask you because I'm I'm planning to graduate in 3 years, 2 years and a half or so, and so I'm really curious about what your tips are for people that are passionate about investing and coming out of university. Um, just generally what to look for after university, I guess.
Yeah, I think the most important thing is having an active mentor. Finding three, four people that um, you admire, either because of their track record or because of who they are as a person, the values they hold in life. It doesn't have to be investors, but they must be people who you admire for, obviously, for good reasons. Um, Reach out to them, speak to them, and find a way to be able to speak with them quite frequent and learn as much as you can. Just be a sponge and absorb as much as you can. The journey of being a mentee is never ending. So now when you finish university, when you're 30, 40, you're still going to be learning from them. I think that's very important. Um, from a more investment standpoint, I think the beauty of the industry is that it's one of the few industries that people are actually willing to share what makes them successful. So if you look at, I mean, if you study NVIDIA, you're not going to get that much insight
Yeah.
into the patents of their GPUs and all these things and, how they do it. But in investing, Warren Buffett, he's written letters every year and he tells you exactly, what he's doing, what he's buying, what he's selling, and why he's made certain decisions. So the way to take advantage of that is just to read as much as possible, whether it's biographies of these guys, value investing books, conferences, just absorb as much information as possible. And I think the final thing is no matter how small your savings is, try and actually actively invest as well. I started with £100. Start really small and put some money just into the market and just observe, your decision-making process. Which ones have done well, which ones have done badly? What did you learn from the ones that did well? What did you learn from the ones that did badly? And have a target. Write if you can. I find writing as a very helpful way to reflect. So just write on your investments and what you're learning and the mistakes you've made and feedback you've gotten. I think if you combine all those things, I, I think and obviously if you have luck, I think you will be much better off.
Awesome. Yeah, I think those are really, really good tips. And I was actually discussing with my dad the other day why investing or the value investing community is like so open and kind of willing to share. And I guess it's because we all have the same enemy that is like, I guess, the benchmark or something.
Yeah,
And we can all win at the same time, which is like interesting because, yeah, I mean, obviously, uh, you can kind of convince everyone else to invest in your stocks and then bail out. But I don't think that's a very good strategy long term.
yeah. And you also don't build a good reputation long term.
Isn't it crazy that 80% of you aren't subscribed? So, if you made it this far, here's my promise. follow or subscribe for free, and my team and I will make every episode 1% better. Check out the last episode too if you enjoyed this one, and thank you so much for listening.